Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, it's time for some fundamental conversations on the markets. Nilesh Shetty, Portfolio Manager at Quantum Advisors, is joining us now. Nilesh, good morning. Thank you so much for joining in. Markets are waiting for a lot of things, be it the US-India trade deal, be it earnings, a lot of macro factors as well. Which one do you think is the most important right now? And what is the outcome which the markets would like?
Yeah, I mean, the markets, actually, I don't think they're waiting. They've already run up quite materially ahead of all these events. And it's not specific to India. There's been a global rally which has unfolded. India, in some sense, has underperformed this rally over the last 3 months. But again, the key driver for India remains earnings. And you saw evidence of a slowdown in Q4 of last financial year. More corporates that we met in Q1 of this year suggest that slowdown continues, not materially altered. So there has been a disconnect between what is happening in the markets versus what is happening in sort of corporate India. The assumption is that at some point there will be a recovery, and people will be watching for that commentary quite closely, where the corporates indicate that recovery. But as of now, it looks like earnings season may disappoint in the near term relative to where valuations are. And given the rally that has unfolded, you may actually be disappointed in the near term in equity returns.
By the way, just a couple of minutes earlier, you were seeing some flashes on your screen with regards to the CEO of Adani Airports making remarks that airport access, lounge access at the airport no longer requires middlemen, and the fintech revolution in the country proves that middlemen can be eliminated and they don't need that, and users can now directly access lounges via the digital platform of Adani Airports. Remember, this comes after Dream Folks, in that exclusive conversation that the management had with us exclusively yesterday, had mentioned that airport operators are pressuring clients that Dream Folks has to move away from the platform and sign on to theirs. And as you can see, the comments coming in there from the CEO of Adani Airports, Madhya, has had this interaction, and we'll get you more on this in just a bit. But these are remarks from the CEO of Adani Airports just a day after Dream Folks had accused airport operators of pressuring clients from their airport lounge access platform. But Nilesh, good morning. Thank you for joining in. You mentioned that earnings, you might see some near-term disappointment. When do you see that recovery happening? There was this earlier view that FY26 would be better than FY25 because there would be a low base of FY25. But do you see that now being pushed to the second half of the financial year, and the first half will be just as disappointing as the last 2 quarters of the previous financial year were?
Yeah, I mean, the reasons for this slowdown is slightly perplexing. When we interact with corporates, they themselves are trying to figure out. The answer that is coming through is urban slowdown and sort of slowdown in urban consumption, which is causing this drag. And again, there are anecdotal evidences that southern cities, which are more exposed to IT, may be creating some of this slowdown because people are worried about job security there. And the expectation is that combination of this tax cut, monsoon, and interest rate cut will combine to sort of pull up demand. But again, that is sort of hypothetical. We'll have to wait and watch because, like I said, nobody's figured out what is causing this slowdown. So the tax revenues that the government was reporting, which was strong till a month ago now, even that is reporting a slowdown. So it is more in hope that there will be a recovery in the second half, assuming these factors combine of great monsoon, tax cuts, interest rate cuts. But we'll have to wait and watch. The point is valuations are far ahead of where they should be, given the news flow that is coming through on earnings. That is a bigger concern. So earnings may recover, but valuations are assuming that there'll be a strong recovery, which may not happen.
Okay. Nilesh, going back to that flash that we just saw where Adani Airports did indicate that they will not require any middlemen for any lounge access for flyers. I'm not talking about a specific stock because I believe you won't be able to answer to that. But in an industry like this, do you think the investors should now book profits or just take away whatever they have in their hands? Because a lot of competition is coming in, and not only this sector. Are there any other spaces where competition could be a problem with companies which were seen to be having moat and being very efficient with that particular business?
Yeah, that is, India has been a classic case of if any specific company starts making supernormal profit, you have unrelated businesses entering that sector and disrupting it in a meaningful way. You saw that in paints happening quite materially. You're now seeing in cables and wires, where essentially it was a 2 or 3 player market. Now other players are entering. But that has sort of been the norm. It is not surprising. The problem happens when you price it assuming there is no competition that can ever come. And then you get surprised negatively and you see a big destruction in your portfolio for these specific companies. So at least for us, when we model sort of long-term valuation for these companies, our assumption is that there will be competition and we bring down margins back to averages which we think are sustainable and then value companies based on that. As long as you're doing that in your long-term portfolio analysis, you're not that negatively surprised and you tend to buy companies at valuations that make sense.
And just as we spoke of this, the shares of Dreamfolks have taken a sharp knock as we speak. So 4.5% lower on that stock. It had opened higher, but is now very quickly hurtling down towards its 52-week low, which is at 209. The intraday low today is 211. So almost there at that 52-week low is Dreamfolks, and now is looking to see some bit of recovery from the lows of the day. But Nilesh, since you mentioned within this competition space, the one space that comes to mind other than paints is of course the wires and cable space. You had Polycab, you had Havells, now you have other conglomerates entering the space, be it Ultratech, be it Adani, and more competition in this space. Do you justify the kind of valuations that these companies currently trade at, be it the likes of Polycab or Havells, not specifically, but the valuations of the sector in general? And is this one of the ways to play the real estate proxy, if so?
I mean, to their credit, these companies have built specific brands in a very commoditized business. Some of the names that you mentioned do make superior margins compared to others. But again, the assumption is these margins are sustainable, which may not be the case. Like I said, if you make superior margins in a commoditized business, you can make slight premiums, but apart from that, you will see competition coming in. And like I said, there are large conglomerates in India who are always eyeing sectors to enter. They generate a lot of cash in their core operations, and you will see them enter that space, which is what has happened. So the valuations were a bigger problem. It's not that these companies will not generate cash in the future. Margins may see correction as other players enter, which again, if you're making much higher than sort of normalized ROEs for these businesses, it will revert to long-term normalized ROEs in 15 to 20% range.
Okay. Nilesh also wanted to understand which other sectors are you seeing some value emerging in? Because you said we've already seen that run up, though India has underperformed the globe. Any space where you think that there could still be some valuation uptick?
So the portfolio follows a value style, and our largest allocation has remained private sector banks, which is where we think valuations are reasonable. They have delivered sort of better returns this year compared to last 3 years. But we still believe when you look at the long-term averages and where they are trading right now, there is significant upside left. Over the last 2-3 years, we found specific names in the saving side of the household balance sheet, be it asset management, insurance, broking companies, which we've added to the portfolio. We continue to have large weights in IT services, primarily the large cap names. I know discretionary spend in the West has been deferred, and near term there could be weakness in growth that they report. But I think they still have tailwinds where, especially if you look at the rupee versus what has happened to the European currencies. Over the last, over this calendar year, the depreciation has been in the order of 15%, which is quite massive. And they do have significant exposure to these geographies outside after US. So we think there is tailwinds there, and you may see some uptick in that sector over the near term.
Nilesh, a sector that has been in the spotlight over the last couple of days has been the hospital sector. There's been a lot of consolidation that has taken place. You recently heard from Apollo that they're going to demerge their other operations from their core business into one listed entity, the digital operations that they have, the pharmacy business as well. What within the hospital sector, or what's your call on this sector here? Do you expect that the sector leader in this space will continue to do what it does and be the preferred pick for the analyst community, especially because now that the holding company discount there goes away as well? Or do you see better value opportunities not in hospitals but in other pockets of the pharma sector?
It's a fantastic macro story given the under-penetration in that space. But again, valuations are so expensive in that space. It's sort of, we've never had allocation there. It's one of those great top-down stories. But if you want to own any company in that space, and you look at valuations, it's just difficult to justify holding them in the portfolio. We've always had exposure to large cap generic names where we found specific names come to valuations which were comfortable for us. But apart from that, it's a sector we would like to own, but it's just priced assuming abnormal growth and high margins for the next 20 years, which makes it very difficult for us to own in a value portfolio.
Okay, all right. Take that point, Nilesh. Thank you so much for joining us with your thoughts on the markets and individual names and sectors as well. With that, we'll slip into a break. When we come back, we discuss market technicals with Vishal Malkan of Malkan's View and also discuss the top trading bets.